Now we come to our second module, covering intermediate technical analysis concepts. In this one, I'll be dealing with candlesticks, classic price patterns, and ending with a few words on Bollinger Bands. Candle charts have been in use in Japan for several centuries, but have only recently been adopted as a legitimate tool in the West. This technique has now become very popular, especially amongst traders. Since this form of charting reflects short-term phenomena, their forecasting abilities are also short-term in nature, rarely lasting more than 10 candles, often much less. There are numerous ways in which to interpret this interesting technique, so let's get started. The information displayed in candlestick charts is identical with that of bar charts. Each method contains the high and the low, as well as the opening and closing prices. It's the way candlesticks display the information which makes them unique and gives them special interpretive powers. When I talk of prices, I'm referring to a particular time period, such as a day, week, or month. While they can be plotted for any period, candlesticks are almost always used with daily and intraday data. In this presentation, I'll be featuring daily and intraday charts, although the principles can be applied to any time frame. Since candle patterns on daily charts only have short-term implications, they're best used for trading purposes as opposed to investing, which requires a longer time horizon. Bar charts treat the opening, closing, high and low prices more or less equally. The candlestick method places a special emphasis on the opening and closing prices. How people feel about a security when they start the trading day and their attitude towards it when the session closes are therefore of paramount importance to candlestick enthusiasts. Opening and closing prices are represented in the chart by a rectangle, such as that as we see here. The top represents the higher of the two prices and the bottom the lower. For example, if the close was $10 and the open was $9.50, the top part of the rectangle will be plotted at $10 and the lower part at $9.50. Now you may be asking the question, how do we tell which is the opening and which is the closing? Well, the answer lies in the color of the rectangle. If it's white or empty, as in the example on the left, the lower part of the rectangle represents the opening and the top part represents the closing price. On the other hand, if the rectangle is black or filled in, the opening is at the top and the closing at the bottom. Normally we like to see the price rise during a trading period, so the black or dark aspect of the rectangle offers a kind of bearish overtone. In technical terms, this rectangle is referred to as the real body. One of the things that confused me when I first looked at candles was that I started to think that black candles meant down days and white candles were up days. That, of course, is not true, since it's possible for a black candle to close above yesterday's close or even above yesterday's high. The fact which makes a candle black is that the close is plotted at the bottom of the real body and is always below the open, which is plotted at the top, like this. For white candles, the open is at the bottom and the close at the top. So here's the open and close which forms the real body. But what of the high or low? These are represented by thin lines which appear above and below the real body, and they're known as shadows. The line above the real body is the upper shadow, and the one below it, the lower shadow or lower wick. A candle having no upper shadow is said to have a shaven head, like this, whereas one with no lower shadow is a shaven bottom, like this. A major difference between Western bar charts and candles is that candles require 4 pieces of data, the opening and closing, together with the high and the low. Without all that information, it's impossible to plot one. Western bar charts require the close and the high and the low, but the opening price is optional. Since the 4 pieces of data which go into the construction of a candle can fluctuate considerably, there are numerous variations in the way in which they are displayed on the chart. Some of these extreme examples have special names and can have forecasting characteristics in their own right. just as bar charts have outside days, key reversal days, and so forth. For instance, a candle in which the opening and closing prices are very close to the low and high, respectively, and the range between the open and close is large, is called a long white line, shown on the left. The opposite, when the close is near the low and the open near the high, is known as a long black line, as shown in the figure on the right. In order to qualify for a long black line, the range between the opening and the closing must be relatively large. As mentioned earlier, long white lines tend to be bullish and long black ones bearish. We shall see later that these variations often form part of a price pattern, in the same way as bars in a bar chart. The principal difference is that candle patterns are usually very short-term in nature and therefore take a much shorter time to complete. The qualification of a long white line can only be determined with reference to the other candles which have appeared in the recent past. For example, what may be considered a long candle in a very quiet and subdued market may be less long than in a very volatile period, when a typical trading range is much greater. Generally speaking, in order to qualify as a long candle, a real body should be at least 3 times the size of the previous candle's real body. The long real body is not usually sufficient to justify a bullish or bearish stance on its own. But what it does say is that it's a very strong statement by the bulls in the case of a white long real body, or the bears for a short one. Consequently, when combined with other technical phenomena, they emphasize the strength of these other characteristics. For example, if a trendline break develops on a candle of a long real body, the penetration stands a far better chance of being a valid one, as you can see here. In effect, the long candle gives the trend break greater credibility. The same thing could be said for a long body which breaks a support or resistance area, completes a price pattern, or crosses a reliable moving average. Long real bodies which develop after a prolonged up or down trend are often a first sign the trend is in the process of reversing. Again, it's important to make sure the long real body is confirmed by subsequent price action. The candle in this example, where the opening and closing prices are the same, or very close to it, is known as a doji line. The interpretation of dojis depends on the context in which they appear. Since the opening and closing prices are identical, a doji represents a session of indecision. When they appear in trading ranges, they reflect an environment in which buyers and sellers are temporarily in balance. They're therefore of very little significance. However, when dojis appear after an advance or decline, the appearance of a more balanced state between supply and demand is a vital clue that the trend may be about to change. A small doji appears as our first example in this diagram. Next we see another candle, this time with a small range, but the open and close are not identical. These are known as spinning tops. Finally, a candle with a big trading range, but where the open and close are high up in the candle's formation, is known as an umbrella line. Finally, the opposite, where the open and close are near the low. This is known as a shooting star, and after a rally is bearish. Note in these last 3 examples, the real body in this case more or less closely resembles a square rather than a rectangle. Umbrellas tend to be bullish after a decline and bearish following an advance. If they develop during a trading range, they really have no significance. Now we've looked at some of the candle variations, I'd like to talk a bit on how these individual possibilities can form in patterns, together with the implication of some of these patterns. I'm going to start with spinning tops. They are characterized by very narrow real bodies, where the shadows are wider. It's the size of the real body rather than the shadow's size which is important in identifying a spinning top. Spinning tops aren't important where they appear in trading ranges, but they do have some significance when they develop as part of a price pattern following a persistent up or down trend. Here we see another spinning top. Again, the real body is very small, but this time the shadows are long. This candle still qualifies as a spinning top because of the small real body. Spinning tops also appear at bottoms, so let me rearrange the candles a bit. Now they're ready, I'll move the spinning top down as well and change its color to white. Spinning tops are the opposite of a long, real body, in the sense that long bodies indicate a decisive market in which either buyers or sellers are in control. On the other hand, they indicate indecision, where participants cannot agree on whether prices should rally or react. When they develop after a prolonged rally or reaction, they're a sign that upside or downside momentum is dissipating. Putting it another way, we could say that in previous sessions, prior to the spinning top, sellers had the upper hand, but the spinning top tells us that the fight is now more evenly matched. Thus, another small change in the balance between supply and demand could tip the price trend the other way. This is why a spinning top is an initial sign that a trend may be in the process of reversing. Only when this is confirmed by other price action, which we'll get to later, should you take action. One other important point concerning spinning tops is their relationship with volume. In a rough way, accumulation is a process where a security moves from so-called weak and uninformed people to stronger, better informed ones. One sign of accumulation develops when prices do not move very much, but when volume is exceedingly heavy. This means that if a spinning top develops after a decline, and the volume is extremely heavy, this adds further evidence the trend is probably about to reverse, as in this diagram. Note how the volume represented by the vertical bars increases tremendously on the day of the spinning top, and where the long shadows are formed. Distribution occurs at market peaks. The process is exactly the opposite of accumulation, in that the transfer is from strong informed traders and investors to weak uninformed ones. Look for a price run-up and a spinning top, which is associated with very heavy volume. Once again, the spinning top heavy volume combination indicates indecision between buyers and sellers. The heavy volume aspect tells us that the level of indecision is very high. Therefore, when the price confirms by declining, a new downtrend is confirmed.